It is June 2026, and right now, the Internal Revenue Service is mailing penalty notices to hundreds of thousands of Americans over the age of 60, and most of those Americans have no idea they did anything wrong. The IRS quietly rewrote the rulebook on retirement accounts, on Social Security, on Medicare premiums, and on estimated taxes during the last 3 years, and the people who built your retirement plan are not calling to tell you what changed. This video is that call. I am going to walk you through the 4 specific fines the IRS is handing out in 2026, exactly who gets hit, exactly how much money is taken, and the 4 legal corrections you can still file before the windows close. If you collect Social Security, if you have a 401k or an IRA, if you sold a home or a piece of land last year, or if you took a single withdrawal from any retirement account this year, this video will save you money. I am going to break the rules down in plain English, give you the exact dollar amounts, and then give you a one-page checklist you can use this week. Here is the truth the IRS will not put on the front page of any website. The people who benefit from you not knowing this are the banks, the brokerage companies, and the financial advisors who collect a fee every time you touch your own money. They do not want you to know about the legal corrections, because if you use them, you keep more of your money, and they earn less from you. So they make the rules sound complicated. They hide the corrections behind forms with numbers like 5, 3, 2, 9, 22, 10, and SSA-4, 4. They tell you to just file it next year, because if they admitted the mistake that cost you, they would have to give back part of the fee they already collected. The IRS does not have a team whose job is to call you and explain how to save money. They only call when they want money back. That is why this channel exists. There is a rule called the required minimum distribution. It is just a plain way of saying that once you reach a certain age, the government forces you to start pulling money out of your retirement account every year. The age used to be 70 and a half. Then it became 72. Now, because of a law passed at the end of 2022, the Secure Act 2.0, the age is 73 for most of you watching this. The age will move up to 75 starting in 2033. That higher age does not help anyone reading this in 2026. If you turned 73 in 2025 or earlier and you did not take out at least the minimum amount the IRS table requires for the year, the IRS sends you a penalty. The old penalty, before Secure 2.0, was 50% of the amount you missed. That was so steep it wiped out retirement accounts. The new penalty in effect right now is 25%. That is still a fine. That is still a tax. And it is still being sent out in mailboxes across the country every week. Let me give you the exact math so you feel it in your hands. Suppose your retirement account held $400,000 at the end of last year. The IRS table says a 75-year-old must take out about $16,000 for the year. You forgot? You thought the brokerage would do it for you. They will not. The IRS table says $16,000. You took nothing. The penalty is 25% of $16,000. That is $4,000 the IRS adds to your tax bill for one missed withdrawal. Where does $4,000 come from in a senior's real life? It is 2 months of groceries for 2 people at Walmart. It is a full year of property taxes in many counties. It is the deductible on your Medicare supplemental plan. It is the cost of replacing a water heater and an electric stove at the same time. To the IRS, it is just a line on a form. To you, it is the difference between getting through the month without dipping into savings and having to call a family member for help. Here is what makes it worse. Most brokerage companies will not warn you when you are about to miss a required minimum distribution. They will send you a statement in October that tells you to review your account. They will not say, you missed the deadline, you owe the IRS thousands, do this in the next 60 days to fix it. Why not? Because your penalty is not their problem. They still earn their management fee. They still earn their fund expense fee. They still earn their cut of every investment inside the account. Your fine is your fine. They keep their money. The good news is buried on page 2 of IRS Form 5329 if you missed a required minimum distribution and you take the missed withdrawal within 2 years and you file Form 5329 to ask for the lower penalty, the IRS will often drop the rate from 25% down to 10%. That is still $1,600 you lose, but it is half of the full $4,000 number. Most financial advisors will not file Form 5329 for you unless you ask. They will charge you extra for filing it because it is a separate form. Ask for it. Demand it. It is your money. Now, I need to talk about something called IRMAA. Those letters stand for Income-Related Monthly Adjustment Amount. You do not need to remember the letters. What you need to know is this. If your income 2 years ago was higher than a certain number, the federal government charges you extra every single month for your Medicare Part B and your Medicare Part D coverage. This is not a one-time fine. It is silent. It comes out of your Social Security check before the check even reaches your mailbox. For 2026, the first surcharge tier begins at a modified adjusted gross income of roughly $109,000 for a single filer and around $218,000 for a married couple filing jointly. Every dollar of income above that line pushes you into a higher tier. The highest tier in 2026 adds more than $400 a month to your Medicare Part B premium and another $80 or so to your Part D premium. That is close to $500 a month. $500 every month for the rest of your life, quietly deducted from the check you earned over 40 years of work. Now think about the math over 10 years. $500 a month is $60,000 in extra Medicare premiums over the decade. 20 years is more than $120,000. None of it goes to your doctor. None of it goes to your pharmacy. It all goes to a surcharge that was triggered by your tax return from 2 years before. The IRS does not look at your life today. They look at last year's adjusted gross income and charge you on that. Here is the what if you need to think about right now. Imagine you are 67 years old. You retired in early 2024. You took a single withdrawal of $80,000 from your IRA in December 2024 because your furnace died and you could not wait until spring. That single withdrawal pushed your 2024 income above the IRMAA threshold. Now in 2026, when you are 2 years into retirement and living on Social Security plus a small pension, every single month for the entire year of 2026, the government will quietly deduct about $300 extra from your Medicare premium. You feel the money leaving, but you do not know why. You call Social Security and they tell you it is a Medicare adjustment. You hang up the phone, you never connect it back to that furnace. This is the trap. The brokerage company that handed you the $80,000 had no legal duty to warn you. The plumber who installed the new furnace had no legal duty to warn you. The government will not warn you. The only people who can warn you are people like me, sitting at this kitchen table, telling you that a single big withdrawal in 1 year can punish your Medicare premiums 2 years later. The fix is real, but you have to plan ahead. If you know a large expense is coming, like a new roof, a new car, a wedding gift, or a medical procedure not covered by insurance, do not pull the whole amount out of an IRA in one single December. Spread the withdrawal across 2 tax years. Pull half in October of 1 year and half in January of the next. Yes, it is a small inconvenience. Yes, it requires a phone call, but it can save you $3,000 or more every year in Medicare surcharges. Over 10 years, that is a used car, a new kitchen, or a grandchild's first year of college. I spend my days tracking these IRS and SSA codes because neither agency has a team dedicated to calling you and explaining how to keep more of your own money. They only reach out when they want money back. The only way to stay ahead of these 2026 deadlines is to be part of this community. Make sure you hit the subscribe button and turn on the bell notification, because once these windows close, your Medicare premium sticks at the higher rate for the entire year, and you cannot retroactively fix it. Here is the one that nobody talks about at the dinner table. There is a rule in the tax code that says if you owe the IRS more than $1,000 at the end of the year and you did not pay enough throughout the year, you get hit with an underpayment penalty. Most people think this only applies to small business owners and freelancers. It does not. It applies to any retiree who has investment income, who sells a piece of property, who takes large IRA withdrawals, or who collects Social Security on top of other income. The quarterly deadlines fall on April 15th, June 15th, September 15th, and January 15th of the following year. If you miss one of those dates, or if you underpay during any quarter, the IRS calculates a penalty based on the federal short-term interest rate plus 3%. In the first half of 2026, that rate is around 8% on an annualized basis. On a $5,000 underpayment, that is roughly $200 in penalty for the year. On a $20,000 underpayment, that is $800. On a $50,000 underpayment from a surprise property sale, that can climb past $2,000. The fix is on IRS Form 2210, but with a twist. Most seniors qualify for an exception. If you are over 65 or if you retired in the prior year with reasonable cause and your only income is Social Security plus a small pension or modest investment earnings, you can often get the penalty waived. The IRS evaluates these by hand. A real person reads your letter. If your story is honest and your documentation backs it up, the penalty disappears. But nobody tells seniors about Form 2210. The brokerage companies do not volunteer it. The tax preparers who charge a flat fee for a simple return sometimes forget it exists. Their flat fee is more important to them than your $2,000 penalty. In 2026, the IRS has tightened its digital cross-checking between brokerage statements, Social Security records, and the tax return you filed. When you pull money out of an IRA or a 401k, your brokerage company sends Form 1099-R to the IRS. The IRS computer now flags every tax return that does not match. If you took a withdrawal from your retirement account and forgot to put it on your return, the IRS sends you a letter asking where the money went. If you do not answer within 30 days, the second letter arrives with a proposed bill that includes a 20% substantial understatement penalty. 20% on top of the income tax you already owe. On top of the state tax you now owe because the state was matching the wrong federal number. The original $8,000 you pulled out of the IRA and forgot to report is now a $12,000 bill. That is why the matching letters are so dangerous. They are not coming because you cheated. They are coming because you missed a line on a long form. How do you protect yourself? Open every envelope the IRS sends you. Do not throw away the letter that says, "We received your return, but need additional information." That letter is your chance to fix the problem without a penalty. If you ignore it, the second letter arrives with a bill. If you ignore the second letter, the case moves to a revenue officer who will call and demand payment. At that point, the negotiation is over. You are paying. The protective action is simple. Every January, request a free wage and income transcript from the IRS website, or call and request it by mail. Look at every 1099-R. Look at every SSA-1099 from Social Security. Make sure every number appears on your most recent tax return. If one is missing, file an amended return on Form 104-0-X before April 15th. The amended return is your shield. Once the IRS sees the corrected number, the penalty notice stops. The legal protections: the IRS will not advertise. Here is the good news that financial advisors rarely volunteer. There are 4 separate legal protections available to you in 2026, and I am going to walk through each one plainly. The first is Form 5329 for missed required minimum distributions. As I said earlier, if you take the missed withdrawal within 2 years and file this form asking for the reduced 10% penalty, the IRS will often grant it. You do not need a lawyer. You do not even need a CPA, although a CPA can help. You can file it yourself by attaching it to your tax return. The second is the request for a waiver of the IRMAA surcharge. If your income went up because of a life-changing event, such as the death of a spouse, the sale of your home, or a one-time large retirement withdrawal, you can fill out Form SSA 44 and ask Social Security to recalculate your Medicare premium. Most seniors do not know SSA 44 exists. The Social Security office will not mail it to you. You have to ask for it. They will not volunteer it because, again, they only call when they want money back. The third is Form 2210 for the underpayment penalty. If you are over 65 or recently retired and you had a reasonable cause for not paying enough during the year, you can request a full waiver. A human reads your letter at the IRS. If your story holds up and your documents support it, the penalty is removed. The fourth is the qualified charitable distribution. This is the most underrated tool in the entire tax code for seniors. If you are 70 and a half or older, you can transfer up to the inflation-adjusted limit, currently around $108,000 in 2026, directly from your IRA to a qualified charity. The money never enters your taxable income. It never counts toward your IRMAA calculation. It can satisfy part or all of your required minimum distribution. The charity receives the full dollar. You pay no tax on it. The IRS does not add a Medicare surcharge. Why does almost nobody use it? Because the IRA custodian does not volunteer it. The charity will not remind you. Only a planner who works for you, not the bank, will bring it up. If you have watched all the way to here, you have been patient. Let me reward you with the exact 4 steps you need to take this week. Step 1 is calling your IRA custodian. Ask them, in writing, what your required minimum distribution was for 2025. Ask them when it was taken. If it was not taken, ask them to calculate the amount and tell you the deadline for correcting it under Form 5329. Write down the date. Write down the name of the person you spoke with. If they will not give it to you in writing, that itself is a warning sign you should find a new custodian before year end. Step 2 is requesting your IRS wage and income transcript. You can do this online at the IRS website in about 10 minutes. Look at every 1099-R. Look at every SSA-1099. Make sure they all appear on your most recent tax return. If one is missing, file Form 1040-X now, in June 2026, while there is still time to address it before the next batch of notices goes out in the fall. Step 3 is reviewing anything you sold in 2024, 2025, or 2026. If you sold a home, a piece of land, an investment property, or even a business interest, pull the closing statement. Calculate the gain. Match it against any 1099-S filed. Match it against your tax return. If there is a difference, talk to a real estate CPA, not the title company, not the agent. Step 4 is sitting down with a fee-only fiduciary advisor for 1 hour, not someone who sells you products, not someone who manages a brokerage account for you, but someone who charges by the hour and works only for you. Bring this video. Bring your last 2 tax returns. Bring your most recent Social Security statement. Ask them to review your IRMAA exposure for 2026 and 2027 and to walk you through Form SSA 44 if your situation qualifies. Do all 4 of these things this month. Do not push them to next quarter. The IRS has deadlines, and they do not bend because life got busy. Every day you wait is a day closer to a penalty notice in your mailbox. Before I close, I want to address something that has exploded in 2026. The IRS does not call you on the phone to demand payment. They do not email you. They do not text you. They do not message you on social media. They send you a letter through the United States Postal Service. That letter gives you a phone number. You are the one who calls back. If you receive a phone call from someone claiming to be from the IRS, claiming you owe money, claiming a warrant is being issued for your arrest, that is a scam. Hang up. Do not call the number they give you. Call the IRS directly at the number on the official IRS website. The scammers will pressure you to pay with a gift card, a wire transfer, or a cryptocurrency. Real IRS agents do not accept any of those methods. They only accept payment through the IRS website, by check, or in narrow cases, by direct debit authorization with your signed consent. If a scammer steals money from you, the IRS will not refund it. Treasury will not refund it. You lose it. There is no government program that replaces money lost in an IRS impersonation scam. So the safest thing you can do is remember this one rule and tell every person over 60, the IRS never calls first. Make sure you hit the subscribe button and turn on the bell, because the next video I release will cover the new rules on inherited IRAs under Secure Act 2.0, and the IRS is now sending matching letters on those too. Once that window closes for the year, you cannot go back and undo it. Knowledge is your only shield in retirement. Do not let them catch you off guard. I'll see you in the next one.